Sentiment on Wall Street is turning sour at the end of the week. The ADP employment report shocked market optimism yesterday, so the market awaited the official NONFARM payrolls in a gloomy mood. As expected, the benchmark stock indexes traded in the red yesterday. Resilient stocks of the high-tech giants cushioned the fall. The Dow Jones lost 366 points or 1.07%. The Nasdaq closed 0.82% down. The S&P 500 shed 25 points to close at 4,411 points. The major stock indexes traded sluggishly in the pre-market, awaiting the publication of the employment report. The S&P is expected to trade in the intraday corridor between 4,370 and 4,440 points. The stock indexes went sharply down amid a massive sell-off in the light of the ADP report, which proved robust employment. Besides, rising yields of the US Treasuries fueled fears about further aggressive monetary tightening by the US Fed. The ADP payroll processor reported stronger than expected growth in the private sector's employment. It proves the resilience of the labor market despite mounting recession fears. The JOLTS jobs openings report showed that vacancies in the US contracted in May, but remained at elevated levels. Released the day before the government data, the ADP report showed no changes in the labor market. In fact, the US Fed does not have to worry about employment and has enough leverage to raise rates further. Yields of 10-year benchmark treasuries climbed 4%, whereas yields of 2-year treasuries, which commonly reflect interest rates expectations, rose to the 16-year high in the light of the report. All 11 sectors of the S&P closed in the red. Energy was the biggest loser, falling by about 2.5%, while consumer goods dropped by nearly 1.7%. The rise in mega capital stocks cushioned the decline in the major indexes, helping them retreat from recession lows. Microsoft shares rose by 0.9% and Apple shares grew by 0.3%. So the S&P and the Dow, however, posted the biggest daily percentage drops since May 23 and May 2, respectively. Among individual stocks, ExxonMobil tumbled by 3.7% after the oil major reported a sharp drop in the second quarter operating profit due to the lower natural gas prices and lower refining margins. Shares of JetBlue Airways plunged by 7.2% on the day after the company said it would follow US judges' May ruling to end its partnership with the American Airlines to defend its planned purchase of Spirit Airlines. Futures for the US stock indexes traded quietly on a Friday before the release of employment data. On the one hand, the latter gave the market a slight relief. On the other hand, they sent an alarming bell. In June, the US economy added 209,000 jobs, after 306,000 in May, and the figure undershot the market forecast of 225,000 jobs and is the lowest since December 2020. At the same time, the indicator is still more than twice bigger than the 70 and 100,000 jobs per month needed to support the growth of the working-age population in the United States. In the first 6 months, NONFARM payrolls grew by an average of 278,000 per month, below the average of 399,000 per month in 2022. The US unemployment rate eased slightly to 3.6% in June 2023, below May's 7-month high of 3.7% and in line with the market expectations. The so-called USDX unemployment rate, which includes people who want to work but have stopped looking, and those who work part-time because they can't find a full-time job rose to 6.9% in June from a 6.7% in May. Although the data point to some cooling, and the Labor Department notes that the unemployment rate has fluctuated between 3.4% and 3.7% for more than a year, which indicates a persistently tight labor market and allows the Fed to raise interest rates further. Wage data became a wake-up call. Average hourly earnings for private non-farm employees rose in June by 12 cents, 0.4%, to $33.58, in line with the previous month's pace and slightly above market expectations of a 0.3% increase. For the year, average hourly earnings increased by 4.4%, slightly above market expectations for a 4.2% increase. The data can soothe investors a little, and the employment report showcases the health of the labor market. It's cooling down slowly and definitely not enough for the Fed. Back to the stock market, we note that the market gave an appropriate response to the non-farm payrolls. Shares of the high-tech giants, which were mainly declining during the day, rushed to growth after the reports, but the momentum quickly faded and they went down. The key indexes responded in the same way. All three major stock indexes are losing ground as the escalation of tensions between Beijing and Washington also winds on the market sentiment. US Treasury Secretary Janet Yellen began a 4-day visit to Beijing by targeting China's recent export restrictions on the metals used in semiconductors and called for market reforms in the country. Tesla shares lost 0.5% after it said it would offer new buyers of its best-selling electric vehicles in China a cash bonus equivalent to nearly $500 if they had a recommendation from an existing owner. Referring to the Twitter social media wars, Elon Musk is poised to sue Meta for launching a rival platform called Threads this week, and US-listed Alibaba shares climbed by 2.8% after sources said Chinese authorities are likely to impose a fine on owned group and in years of a regulatory overhaul for the fintech's subsidiary. Also in the spotlight are JP Morgan Chase, Citigroup and Wells Fargo, which will open their second quarter reporting season next week after the biggest banking crisis since 2008. The stock market gave a muted response to the employment data. However, in the currency market, the US dollar index tumbled to 102.60 immediately. The index recouped some losses in midday. It's opening the New York session at 102.80, and the intraday corridor is seen between 102.50 and 103.10. Although the futures remain hot, the fact that they are moving in the direction of a cooling has quelled the optimism of the dollar index. At the same time, today's statistics are unlikely to have a significant impact on the Fed's decision. The regulator is likely to raise the funds rate by another 25 basis points in July and signal further monetary tightening. Dallas Fed President Lori Logan confirmed this agenda in the speech on Thursday. She said there were grounds for a rate hike at the June policy meeting, and she signaled that further rate hikes would be needed to cool a still strong economy. She said that she remained very concerned about whether inflation will return to the target level in a timely manner. On a Friday, traders are betting that the Fed would raise its benchmark interest rate this month to the 5.5%. Fed funds futures rose following the non-farm payrolls. In addition, traders now see about a 1 in 3 chance of a further rate hike in November compared to a 50-50 chance before the report. The Canadian dollar advanced to meet the soft American counterpart and red-hot employment data. The USD CAD pair slid by 0.28% to trade at 1.3329 in the intraday corridor between 1.3290 and 1.3370. The Canadian economy added 59,900 jobs in June, much stronger than the consensus. Besides, the jobless rate rose to 5.4% because more people are now seeking employment. The figures beat market expectations, which suggested a net gain of 20,000 jobs and an increase in the unemployment rate to 5.3% in June from 5.2% in May. The unemployment rose in June for the second month in a row. It's currently at its highest level since February 2022, although still below the 12 months pre-pandemic average. The June jobs report is one of the latest economic data ahead of the Bank of Canada's interest rate announcement on Wednesday. The central bank raised the rate to 4.75% last month on fears of a tight inflation, but said further steps would depend on fresh information. Last month's data showed signs of lowering inflation to 3.4%, but a tepid May jobs report and lower commodities prices could encourage further rate tightening by the Bank of Canada. Such prospects supported the loonie today. As for oil quotes, they fluctuated between rises and dips today. Brent crude fell by 0.11 to $76.43 a barrel. The crypto market is trading mixed today after a plunge yesterday. Bitcoin is hovering above 30,000 and popular altcoins traded mixed in the pre-market, but entered into the green zone in the early New York session. Bitcoin continues to fluctuate in the range of $30,000 and $31,000. The asset has serious support and resistance at these levels. A breakout of the borders can lead to the token either to decrease to 29,600 or to rise to 31,500. Thank you for watching. We closely monitor the markets and provide you with the up-to-date financial information and analysis. We are waiting for your questions and comments and wish you profitable trading and have a nice weekend. Subscribe to our channel and see you online on Monday.